for the last like quarter, it seems like people have been calling, a recession. A recession's right around the corner. But we have the Nasdaq off to its hottest start ever to start, first half of a year. We obviously have Bitcoin ripping, and yet inflation data is rolling over, and people are fearing a recession. You have other disinflationary signals. We have PMI contracting. We have shipping rates in the toilet now. We have, all of these. The commodity index is down pretty big. All these signs, the yield curve still inverted. You can just go on and on and on about the economy, but asset prices just keep ripping. And so, what's your guys' takeaway right now with the broader macro picture? And where do you guys think things are going in quarter three? So, to Preston.
I think I can't remember what I said the last time we met, but I think I was talking about the momentum on the equity market just had shifted and turned green,
Mhm.
and that it was despite all the headlines. If I'm just looking at the price action, it's telling me that we're now starting another bull market. I think I said that last quarter,
Yeah.
and okay, I did. So, yeah, so it's done well. That thesis has continued to play out. I have no indications that that's letting up in equities and that equities are going to continue to outperform the dollar, is what I would compare it to. With respect to fixed income, I suspect, I can't remember what I said, but I suspect that I would have said that there's no indications that the sell off is over and that the sell off is going to continue, based off of the volatility and the trends that I was looking at. That has definitely been right over in Europe. In the US, I think it's continued to sell off since the last time we met. Um, and I think I remember talking about oil being the thing to really kind of watch, and wasn't quite sure whether that's breaking out or not breaking out, but hitting its low. I think that has gone. Let me pull up a chart real fast from the last time we talked. It has gone pretty sideways since the last time we've talked, which would potentially confirm that we're seeing that pivoting and that the bottom is being laid right now. Um, a lot of people would disagree with that oil thesis because they're expecting a recession. They're expecting, like, when you look at bankruptcies, especially in the commercial sector, the issues that are happening in the commercial sector, I think a lot of people are expecting that to get really nasty into the third quarter and fourth quarter. And it may, I think on the real estate side, commercial real estate side, it may. But it seems that there's been a pivot in central banking policy, and that they are being more accommodative through all the different levers that they're able to pull to make sure that there's enough liquidity in the system. I don't, I, my concern goes back to my point that I made on the last quarterly update, which is, if oil, and this is a huge if, I don't know that it's going to do this, if it starts to rip and starts to bid, like it is going to cause all sorts of issues because of the treasury market sell off that will then continue to go even further than it was the last time that we talked. And that's going to cause all sorts of balance sheet issues for banks and anybody at that point, because they have to, as they're rolling the debt, it's just getting harder and harder. And I just don't know if what we're seeing in equities, and I had a little bit conversation about this with Luke Roman recently, is is the price action we're seeing in equities, the flow of funds coming out of fixed income, and it has nowhere else to go because it has to chase after something that has a finite supply. Is that what's causing the equity run that we've seen? Is because you have this consistent selling happening in fixed income, and is that going to be persistent, which will cause the equity market to continue to run? I don't know, but the price action is telling me that it's still a bull market, that it's, since the last quarter, we're still in a bull market in equities.
Well said. So first of all, people should listen to Preston's most recent conversation with Luke Groman if they haven't already. It was a great one. It always is.
Thank you, sir. Thank you.
It always is. And also, people should listen to Preston when he drops hints like, my momentum model is telling me something may have shifted in the market. Guess what? That was dead on right. It's not the first time I've heard him say something like that, and it's it's been an indicator of what's to come. Not financial advice. Um, so, uh, yeah, it's I couldn't have put it any better. I really don't have much to add other than the economy seems stronger than most people thought it would be, despite the fact that rates are so much higher. Stimulus out of China may be helping to goose things at the moment because their reopening was weak and they've decided to stimulate more recently. So that could be a factor. I'm still cautious about a recession. It may not happen. It probably won't happen this year, but I still think more likely than not it happens by the end of next year. But, we have to be we have to listen to the market, and we have to be positioned basically for any and all possibilities. And so, yeah, it's been more important to be diversified if you're a normie than ever. And if you're a, hardcore Bitcoiner and can suffer the volatility, that's a different way to live. But yeah, these are as uncertain times as ever with respect to which way are asset prices, likely to go, especially in the short term.
Andy, what are your thoughts on the flow of funds coming out of fixed income into equities, and that's what's driving the bullish price action that we've seen for the year?
Yeah, I think it's a really interesting idea. I think that um I think that definitely on average the statistics would suggest that a lot of people are offside in the sense of they sort of what's the word? They got cautious, they got nervous, they sort of fled to or hid in short-term fixed income. Talking about,
Hmm.
T-bills basically and money market funds. So I think that there's perhaps never been as much money in money market funds and T-bills ever as there is now, which
Hmm.
means equities are under owned, which means that, when you start to get a positive trend in equities, anyone who gets evaluated on short-term performance has their has their oh shit moment and realizes they're off sides. If you're a hedge fund manager and you get paid at year end and the year's half over and you've been too conservative and you haven't made money, you start to
Hmm.
get nervous. So I think that could be a real factor. And yeah, as to the hypothesis about specifically the huge fund flows coming out of fixed income having to go somewhere, I think that's true. Sort of suspect that more of the flow has been into short term. So if you're saying, okay, like the
Yeah.
long end of the curve went up, so like, treasuries and mortgages and junk debt lost a bunch of assets. Assets flowed out of there. I suppose I'd assume that more of the flow went into money markets and short term treasuries, but it
Hmm.
wouldn't surprise me at all if a significant amount went into equities.
Yeah, I agree with that. I mean, that's why. Yeah.
Which is to your point, it's like, look, when the flows are that large, even if it's, some slice of the flow going into
Yeah.
another asset class, it still moves the needle.
You're gonna have to get somewhere. Like, let's just play a scenario. I'm not saying this is my base case, but let's just say that energy prices do rip into the close of the year, right? Now, all of a sudden, all of your yields on bonds are gonna have to sell off even more than where they're already at, right? Those yields are gonna blow out. Everybody that's having to recap their duration in fixed income is going to do it at higher rates, which means that their earnings power for equity is lower. They're like, where can you move out of fixed income at that point? Then and assume you don't understand Bitcoin, because that's most of your people, or think that Bitcoin is just like, this fake magic internet money, which is most of your participants in the market. Where do they go? They have to go into equities. Michael Saylor does such a great job talking about why it's so hard to own commodities. So, like, even if the commodity prices are ripping, like, if you're buying any type of spot, like, you get into this duration issue where, like, some of the stuff that you're buying is only good for 30 days, or, like commodities are really hard to do unless you're just in a really short time window from like an investing standpoint. But most investors, in my opinion, most investors that are like really making the big moves, they're long-term investors. They're trying to own something for multiple years. And so like, where does that person go? Especially if they're coming out of fixed income, like where is that person going to go other than the equity market to preserve their buying power?
And imagine the, the narrative and the story here, because we see it's been, yes, the base of stocks in the Nasdaq has been broadening in terms of the ones that are making gains, but still most of the gains came from a handful of AI linked companies, right? Not only do you have this strong narrative in AI, but Preston, what you said about refinancing risk is spot on. What companies don't have refinancing risk? These
Yeah.
giant fortress balance sheet tech companies, right? They have net cash, not net debt. So unlike higher levered balance sheets that have debt that have to refi at higher rates, these guys, these guys are bulletproof in that regard.
It's amazing in business school. Like if you're looking at a company and it has no debt, like the professor's, is going to push up his glasses and be like, well, they need to issue some debt because they're going to have a higher bottom line because they're going to get this advantage for their interest expense, right? Which makes sense, but it's like, why are you trying to accelerate time if you can't employ the borrowing, the proceedings that you're borrowing, right, into some asset that is a reason why you're trying to outpace your competition. And so I think it's been such a business practice when interest rates always go down for 4 decades straight. It becomes this thing that you just take on debt because you make more money if you take on debt because of the way that the accounting works, right? And so they've done this, and the companies have done this year in and year out for 40 years, only to find out that when you have to roll that debt at a higher interest rate, all of a sudden that little neat calculation that your interest expense like reduced your income, and you actually made more money by having debt on the balance sheet. All of a sudden, that's just not as valid anymore, and you're making less money, and you're scaring the hell out of yourself because the ratio of interest expense to income is not even close to what it was before when you had a 0.5% or 2% interest, and now it's 4% interest or 7% interest or whatever it might be for name it company. It's a drastic shift for corporate executives. It's a drastic shift for CFOs that they've never had to deal with in their entire lifetime. And they need to wake up and stop listening to the people teaching these MBA programs.
Yeah, I would not probably want to be a corporate treasurer at a highly levered company
And there's a ton of them.
2020s.
And that's the base case. Most of them are.
Support group.